Matter up, people. Happy Friday. It's time to put your feet up on Friday and think about what property investing can do for you or this guy walking past with his coffee.
I've worked for the last 6.5 years for one of the big banks and done a lot of investing. So worked a lot in the Sydney markets, a lot of big investment properties, investment portfolios, working for one of the majors, and just recently jumped over to join George and Tao as mortgage brokers and for CFC Finance, for those of you who don't know George. And so jumped onto CFC Finance, and the reason why I made this shift to work with people like Luke at helping people grow their portfolio and looking at multiple options, and that's why I love being a broker, looking at different solutions, different possibilities, and not having just one product to sell, but how do we have a range of different services and solutions that help different people. So that's what gets me excited about helping people. At the moment, the lending environment, there's a lot of uncertainty, and so now more than ever, it's important to have the right team around you, understanding where banks are looking at. Some banks got postcode restrictions on different developments. Some banks will look at different things differently, so different income, whether you've got self-employed or contractor or PAYG, and different deposit requirements as well. So it's very interesting. And with the Royal Commission happening at the moment, there's a lot of uncertainty. There's a lot of questions being asked of brokers and of banks. And so it's important to have a broad understanding of that. And so that's why working with the right team is really important. In the end, if you do the deals, and even the brokers that work directly for the one bank will still get paid from the banks. So banks understand that there is a payment for acquisition. So either they'll pay their own staff to do it, where they're guaranteed to get the deal to that bank, or they'll pay a broker to do it. Now, brokers, and as Luke said, I'm biased. Now, only 4 months ago, I was one of those bankers working for the big banks. And the thing I love about a broker, still being biased, is I don't have to put my clients and force my clients to fit one thing. And whereas before, my job wasn't to necessarily sell the best product, but was to sell the clients why they had to do what the bank wanted them to fit, or to fit into the box that the bank had. Now, not all clients fit that mold. So some banks do really well for investors, or really well for self-employed people. They've got really good policies for self-employed, but they may not look at others as favorably. Well, others have less favor or less interest in the self-employed. So then how do I force my client to fit in the box that I'm selling, as opposed to using a broker where I can find the right solution for your individual circumstances, making sure that whatever you're doing matches up to your long-term aspirations. Expenses is the big thing at the moment that's coming through with the Royal Commission, and we're seeing actually all the lenders, every lender, non-conforming, conforming, second tier, non-banks, all looking a lot deeper at what are your actual expenses. And I think understanding your budget and understanding what are your core requirements. If spending 30 grand per child to send them to King's is important to you, you need to budget that in, because that's something you may not drop if the market does take a turn, or if something goes wrong. So understanding what are your non-negotiables, what are your key fixed expenses that you wouldn't be able to drop, I think is vital. And understanding how much living actually costs, and then when you know that, what sacrifice are you willing to make to get your first investment property? What sacrifice are you willing to make to say a little bit of short-term pain, a little bit of hustle now for the long-term gain?
Myself included are coming out of interest-only periods where we've had properties that have been in for 5 years, and now we're considering what's the options. What do we do with this?
I think the first thing you do is talk to your trusted advisors. So talk to your team, your accountants, your financial planners, your property coaches. Understand what's your long-term vision for these properties. Yep. Number two, the options for rolling over interest-only periods are nowhere near as flexible as they used to be. Only 2 years ago, it's a one-page form, you fill it in, they give you an extra 5 years. Now there's a full analysis, so they will look at your income, your expenses, your total overall position.
And that's what the RBA are talking about right now, and that's why they're worried about what's going on in the marketplace, because people like myself and many others are coming out of these interest-only periods now, and then, in the next year or two will be when financing is a little bit tight. So what do we do from there? What's your position, and how do you help clients like myself and like others that are coming out of these periods?
So that we do have lenders, and there's still lenders in the market who are willing to look at these and look at the extensions and the rollovers, and to give yourself that 5-year interest-only period extension again. And you're finding a lot of them where potentially you've still got a year, maybe 2 years of interest-only period left, where you may make the strategic decision now to say, let's review now, because you don't know what's going to happen in a year's time. So if you know you've got 4 or 5 properties coming up in the next 3 years, 2 years, 1 year, where they're going to all roll over to interest only at the same time, and there's quite a few clients who would have bought in the last 5 years as we've seen the property cycle turn, and they're all going to be turning to interest to principal and interest at the same time.
Talk to your mortgage broker about what's going on. They're your contacts. They're continuing to review your portfolio, so you want to think about the strategy moving forward and not leave it to the very last minute and get to a point where you're changing your rate to a higher rate, you're changing it to principal and interest, and you're not in a position to actually afford the repayment. So that's a consideration that everyone wants to make in terms of if they're holding a property portfolio at the moment. Sidhu, we've got Josh and Sukawinda. Amy has also joined us, and Anne-Marie. Thanks for coming along. Myself and for clients.
Yep.
Where is it coming in towards, I know there's a big push for you guys in your office to work in the first home buyer space at the moment. Why is that, and how are you helping first home buyers?
Thanks, Luke. I think first home buyers, there's an opportunity for them to jump into the market that hasn't been there for a long time, especially with stamp duty exemptions, and lenders are looking favorably at these clients. They also don't have the same restrictions from credit policy that clients with 2, 3, 4 investment portfolios may already have. So we're seeing a lot of opportunities to help them, and I think the same as you, set the vision, set the goal, and for a lot of people there's the emotional benefits of owning your own home.
What's a typical goal for a first home buyer right now? Is it a 5-year, is it a 10-year plan? What are they kind of looking at?
Everyone's different, and we've got lenders who will do 95% lends for first homeowners. So it could just be a 3-month, 6-month goal. But for others, it may take them 5 years to save that deposit. And we're talking this morning, and it's important to have a little bit of that hurt money, that you've got to work to get this, and anything worth having in the long term, you need to put some pain in. You need to understand what the goal takes.
Yep.
Understand that you have to sacrifice to get there, but it's very difficult to sacrifice to save money to put in a bank account. But if you can sacrifice, and I joke around about it, I know George teases me about the smashed ovos. If you're stopping having smashed ovo toast so that you can put money in the bank account, that's not much of it doesn't inspire you. So yeah, I'm going to order the smashed avo. But if you're saving and not spending the $20 on a smashed avo so that you can go buy an investment property, that's an entirely different mental shift. And it's about getting the right mindset, the right attitude, and the right long-term goals, and understanding a little bit of pain now for the long-term benefit is essential. We're not suggesting a first home buyer on 2 incomes of 70 to 80,000 go buy their $1 million dream house in Kellyville, because the pressure that can put on a family is quite intense. Also, you need to understand their goals. So potential family changes in the next couple of years, income changes, what are they looking to do, and how do you set up a strategy for them?
Sometimes, and what you have to be really careful of, maybe go for that Prospect or Blacktown place instead of a Kellyville place as an example, and then work on it, renovate it a little bit over the years, and then you may look at a strategy where you either upgrade to your dream home down the track, or you look to talk to someone like me in terms of investing, and then build up your wealth to get your dream house in like maybe 10 years or 15 years, instead of having and wanting to get your dream house straight away the next couple of years. George, it's probably a question I'd love for you to answer as well, but let's ask Kyle firstly.
I think no one has a crystal ball, and the deals we were doing
That's really soft. We want the freaking hard facts right here.
Definitely. So definitely credit policies are going to change. They're changing already.
You switched like that, I love it.
Changing already. So we don't know what's going to happen in 2 years' time. There's a lot of uncertainty. But we know that policies will change. We know that Royal Commission will trigger either the banks to become more conservative in certain areas, so that's something to consider as well. And we don't know what's going to happen with the market, but what we do know is get the right advice, get certainty with where you're at right now, and plan ahead. Have a strategy for where you want to end up. Your repayments on your portfolio if the interest rates go up. So it was only 6 years ago when I started in finance, coming up for 7, that there was only one bank under 7%. Now, under 5% is the norm. A lot of them under 4% for owner occupiers. It's a different market, but in 6 years' time, it may be back up there again.
What about for first home buyers? Is there anything that's coming out in the marketplace that might help them get a leg up over, going through a bank direct?
Correct. There's some second tiers and some non-banks that are willing to be a little bit more flexible. Some banks doing things such as a 40-year loan term that for investors may not be the most suitable, or for someone who's 50, a 40-year loan term is definitely not in their best interest. But for 25-year-olds, 30-year-olds, 35-year-olds, where you're going to be working for the next 40 years, gets you into that property a little bit sooner,
yep,
with the strategy that you're going to pay it off faster. So especially for owner-occupied debt, it's important, if your long-term strategy is to pay that off, that you pay that off fast, because that's what I like to call bad debt, although no tax advice here, because it's non-deductible, it's debt that you lose. So paying that off fast, paying it off well before the 40 years, but giving yourself a buffer, because it's important to have the buffer. Because there's uncertain life events that come up. So potential to have children earlier than planned, income changes, but these first homeowners, they're at the bottom of their income potential. Their income potential is going to be dramatically increased over the next 10, 15, even 5 years. So how do you help them now get into the market, start in the market, and if that's a first homeowner, that's great. If it's rent vesting, if you want to live in Manly, if you want to live close to the city, you don't want to pay 1.5 for a house, how do you set up a strategy with the right team to buy an investment property and rent where you want to live?
It's something that I do and I advocate for many people, especially if you want to live closer into capital cities. More often than not, you're in a situation where it is actually cheaper to rent than own a property, and that's what I'm currently doing. And I encourage people, if they're looking to live closer into the city, it's more advantageous to do that as well.
And we've got 40 different lenders that we work with, and each of them have different policies. So one will take overtime income. So I'm doing a loan for a nurse at the moment. One bank will say, we'll use all of your allowances because we understand the industry, we'll use it. Another bank will say, we'll only take 50% of that income. Now,
massive.
If you walk into that bank that says, that's my main bank, they'll only take 50% of that extra income. That's the difference between being able to buy now potentially and having to wait another 6 months. If you go straight to their bank, they won't tell you that somebody else will do 100% lend on that. Whereas coming to a broker, our job is to understand all of those policies, understand you. So we sit down, have a quality conversation with you. Where do you fit, and then which is the best bank as terms of policy, not even price, because they're all doing pretty competitive pricing at the moment. Which policy will help you get to your desired goals? And that's where a broker comes in.
And how do you make it easier than clients simply going directly to the bank?
Yeah, great question. And a lot of clients want to do this. They look at their properties, they go look at 500 investment properties on realestate.com.au, and they look at the things, but knowing somebody who's been up there, I'm switching it. So the same with experts, someone who knows the area, someone who knows the lending area, knows which banks straight away. You can come see us and say, this is my income, I'm a nurse, my husband's self-employed, we're looking to do X, Y, Z, this is my deposit. I know straight away because I've got the experience, and our team knows, and brokers should know, well, this bank will give you a loan with that deposit, this bank will give you your overtime income, your employment income, and this bank is okay with self-employed, and this bank will do all three. So this is going to be your best option that you may only get from a second tier, or you get from a major, but even the majors' policies are different. So it's very important. Thanks for the question, Con.
It's been a long one, but I think very vital in terms of what's going on in the lending market right now. You really need to be focused on continue to have those conversations, not just one, but on a continual basis about what's going on with the lending and how you can position yourself. So thank you very much, Kyle, for coming along today.